mostly gold would consolidate sideways, and then we're targeting 10,000 by 2030 because of what's going on in the global sovereign debt crisis. And gold is consolidating. It's acting a little better now. Again, like you said, we're not into the short term. The deficit certainly doesn't seem to be slowing under Donald Trump. They keep announcing, increasing the military budget 500 billion, I think it's $1 trillion. They want it $1.5 trillion.
Unchecked government deficit spending and soaring sovereign debt obligations are pushing the global financial infrastructure toward an inevitable systemic breaking point. With fiat currency systems strained under trillions in new debt issuance, conventional fiscal policies can no longer contain the growing structural fallout. Edward Dowd, a respected founding partner and former Wall Street portfolio manager, contends that this escalating sovereign crisis will trigger a massive wealth migration into hard assets. Specifically, gold is projected to complete its current sideways consolidation and surge toward a $10,000 price target by 2030 as systemic debt distress accelerates across major economies. As central banks find themselves trapped between currency debasement and bond market instability, physical precious metals will serve as the premier counterparty-free hedge against sovereign default risks. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I said gold and silver, mostly gold would consolidate sideways, and then we're targeting 10,000 by 2030 because of what's going on in the global sovereign debt crisis. And gold is consolidating. It's acting a little better now. Again, like you said, we're not into the short term, but the deficit certainly doesn't seem to be slowing under Donald Trump. They keep announcing, increasing the military budget 500 billion, I think it's $1 trillion. They want it $1.5 trillion. So there doesn't seem to be any slowing down in the deficit. And what's going on in Japan as well. Gold is, like you said, is nobody else's liability. And my contention is that this global sovereign debt crisis, the release valve was going to be a currency somewhere, and a central bank having to make the Hobbesian choice between saving the global financial markets or saving their own economy. And that's exactly where Japan is right now. When the administration first announced what their plan was, it was awesome. So, they were going to try to reduce the deficit to 3% of GDP from its current 6 to 8% that we've had since Biden and still under Trump. That was going to be a good move. It would bring yields down. They were going to get rid of fraud. They were going to drill, baby, drill. And they were going to try to grow the economy by deregulating. And that was Besant's plan. The war has screwed everything up. And look, that wasn't Besant's decision. And so, I wouldn't want his job. I mean, when you're in these positions, and let's say I was Treasury Secretary, I can't come out and say what I'm saying now about the economy because that would scare people. You just can't. But my job as an outside observer is to read between the lines, and he's saying what he has to say. And the press secretary just left because I think she got tired of holding water for the Trump. Every press secretary under these administrations, it doesn't matter Biden, Obama, Bush, they all leave because they can't handle how much nonsense they have to say. I guess there was an analysis done that I thought was pretty good about what China did. China kind of saved everybody's butt, apparently. They stopped importing oil and started drawing down their own SPRs, so they didn't put pressure on the markets, which honestly, that helped out Trump. But they also were helping themselves out because if the U.S. goes into a massive recession, China's already in a problem. That only exacerbates their problem because even though there's tariffs and all this, they still sell goods to Europe. Then Europe slaps on their stuff and they sell it to us. So there's been ways that China's been getting around that. So if we go into a recession, it's going to be bad for the factory of the world. So that's why I think we haven't seen these shortages show up yet. But we're seeing a lot of smart people, smarter than myself in the energy complex, are pointing out the refinery spreads. That's why gas prices haven't been coming down. So we have a refining capacity problem, not an oil problem at the moment, and we'll see what happens as we roll through time. But there's always lags to these things. I mean, we had the oil really kind of peaked out in May, and headline inflation peaked out in May. And it's going to be coming lower, but we saw that retail sales kind of had a bad month last month. So that's kind of the tax working its way through the system, and it was a mini shock, and it's created demand destruction, and people are cutting back, and people are not happy, and the poll numbers for Trump and the GOP are not good at the moment. We were going into in 2019, we were going into a global growth slowdown, and then miraculously, in quotes, COVID comes along and gave the governments and the central banks of the world the excuse to basically spend like there was a war, and the war was COVID. The unprecedented money printing and then spending by the governments. There's two things: you print the money, but the money needs to get into the system. The government took the money the Fed printed and handed it out, and that was really what caused the inflation. The inflation was born under Trump in 2020 and the Fed. There's always a lag in monetary policy. It showed up 18 months later in 2021 under Biden, and then the Fed raised rates. And we're stuck with those even though we have inflation coming down in our models and core inflation, and there'll be a deflationary scare. But the cumulative price hikes are not going back to where they were. The rate of growth in inflation may be slowing, but we're not going back to pre-COVID. And unfortunately, wages haven't kept pace, and that's why people feel poor. And we had the immigration problem, which Trump has, did close down the border. The mass deportations haven't happened. We have the HB1 visa problem. So there seems to be a wage problem in the U.S., and the only game in town is AI, and that only helps a very few select group of people. Some construction workers on the data centers, and mostly VCs and bankers and people investing in AI stocks and chip makers. When the housing market rolls over as it is, that's 20% of the economy. The economy is just not going to do well, and it's not doing well. And the truth of the economy will be discovered soon enough. I would become more suspicious if we have the bust that I think is coming. There'll be a resetting of valuations, and there'll be some bankruptcies. If the government comes in, and people think the government's going to bail out AI, they're not going to bail out AI. They're not going to go to Congress and say we need to raise $3-4 trillion to bail out the data centers. That's not going to happen. What I would become suspicious is if the government steps in and takes ownership of some of these assets at pennies on the dollar. Then the surveillance digital prison thesis, it's right there in our faces.
Under the surface of conventional public markets, severe structural distress is accumulating within the opaque private credit ecosystem. Because these debt portfolios mark their own internal book values rather than trading on public exchanges, underlying balance sheet decay went largely unnoticed until sudden corporate bankruptcies emerged across consumer-facing and auto-lending sectors. As everyday household cash flows deteriorate, institutional credit funds are confronting escalating loan losses and are moving aggressively to gate investor redemptions. This illiquidity poses serious contagion risks for pension systems and insurance providers heavily exposed to these unvetted loans. Compounding these systemic domestic headwinds, refinery capacity bottlenecks keep fuel prices elevated, applying relentless pressure on retail consumers across the real economy. Now, let's get back to the interview.
Here's the thing about private credit. It doesn't trade. It's opaque. They mark their own books. So you have to look for signposts of what's going on. And the beginning of the private credit woes began in the fall of 2025, when First Brands went bankrupt, Tricolor Auto, and people started to question, hold on, how did that slip by you guys? Oh, and then there were a couple. BlackRock marked one of its positions from 100 cents on the dollar to zero a month later. So people started asking questions. What's going on here? So people started asking for their money back. Then the gates went up, and then then Q2 came along. More people asked for their money at an accelerating pace. The gates remained, and so what we have now is an outflow problem, not an in. And so the question is, are they still getting inflows? Any kind of credit mechanism needs constant flow, and the flows are shutting down. and the losses are accumulating. PIMCO said we're in the part of the credit cycle where we're going to get a default cycle, and that's because the real economy underneath is caught. First brands went belly up because they were servicing aftermarket auto parts, and that's Joe Sixpack. So Joe Sixpack wasn't doing well, and Tricolor Auto was to immigrants. These loans in these portfolios to these like industrial companies or roll-ups like dentist offices or veterinary offices, they're coming under pressure because the Joe Sixpack's cash flows are going the wrong way. So I can't tell you when it's going to blow up, but certainly for a guy like me who's into pattern recognition, when you start to see, CEOs of these private credit funds within a 3-week span, one from BlackRock, one from Blackstone, and I forget there was another one. It doesn't bode well. There's clearly something bad going on behind the scenes. And then to add another problem here, people have been doing really good work, examining the insurance companies that are, that a lot of these private equity guys who also do private credit funds bought insurers to stuff a lot of these loans into. So now we have an insurance problem potentially. So ultimately, the people on the hook are going to be the pensioners, the insurance folks, the wealthy individuals that bought these funds. So, we'll see what the losses look like. So private credit's never been tested before. It was born out of the great financial crisis. So we're going to see what it looks like when it's been tested. And it's the junk bond market at least traded publicly, so you knew what was going on. You could see spreads widening. This is opaque. But what we do know is flows are going the wrong way and people are leaving. It doesn't bode well. Raise some cash in your portfolio so you can take advantage of cheaper prices. If I was running a hedge fund, I wouldn't be shorting the S&P. I wouldn't be playing it, and I'd be cash, gold, and looking to get longer duration treasuries. I'd already probably be long them and add to positions when they get weak, like they did recently with the yield scare. Because when this breaks and the truth comes out, it's going to go from people worrying about inflation to worrying about growth and deflation, and the Fed will be turning on a pivot and lowering interest rates super fast. We're not there yet. When it happens, it'll blow people's minds how quickly it goes on. Because if you've looked at every rate hike cycle, plateauing cycle, then lowering of interest rates, the equity markets have not done well when we're lowering interest rates fast. And that's we're in the part of the cycle where we started lowering rates. We're still hitting new all-time highs. Once this talk of Fed rate hikes goes away and the true economic growth comes to bear, and that's what when the AI bubble finally gives up some ghost, it'll be fast and quick, and you won't have time to position yourself.
Navigating this macroeconomic transition requires strict capital preservation and a strategic allocation shift before broader market sentiment abruptly changes. When underlying economic realities fully surface, institutional focus will pivot from lingering inflation worries towards severe growth contraction and deflationary stress. Historical market cycles clearly demonstrate that rapid emergency interest rate cuts by central banks coincide with sharp equity drawdowns rather than sustainable rallies. When speculative tech valuations unwind, liquidity shocks happen far too rapidly for unhedged portfolios to react. A resilient portfolio framework centers on building substantial cash reserves to acquire high-quality assets at steep discounts once the broader market cycle resets. Concurrently, maintaining exposure to physical bullion and accumulating long-duration treasury bonds provides vital capital protection as yields drop during flight to safety episodes. Maintaining disciplined defensive liquidity while avoiding overcrowded, over-leveraged market sectors remains the most reliable strategy for protecting wealth through systemic credit unwinds. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.